This is John Vance, president of Vance Wealth. I'd like to welcome you to our February 2021 edition of our Advanced Perspective webinar series. Our motto is Achieve More. We're actually in our studio. I can't remember if we did this last time, but I think we were in our studio last time. So hope you enjoy our new scenic backdrop here. I know you're not going to get to see me because I'm going to pull up the slideshow here pretty soon. But as always, thank you guys for attending. I always enjoy doing these. Today, we're going to go back through a little bit of a history lesson. I know that's been kind of a common theme over the last 3 or 4 months. And I got some fun stuff to show you. So like always, from a housekeeping perspective, if you have questions, go ahead. Tara White is with me, just kind of monitoring questions, and just go ahead and type in the Q&A. And then what I'll do is I'll make sure that I check them out and answer them. My guess is probably be about 45 minutes today. I know last month was a little bit longer, so I tried to cut down, but I got lots of good slides today, so I'm excited to show them. So I'm going to go ahead and share my screen and get us going. All right, let me hide this. Okay. See if I can get everything working. So compelling wealth management conversations. That's what we're going to spend some time on today. As always, our disclosures: Vance Wealth is a registered investment advisor. So when we start looking at like how we view what we do for you in terms of investing your money, obviously financial planning is a massive part of what we do. But when we start just talking about the role that we serve when we're managing money, a big part of that is making good decisions with the investments, but it's also a big part of it is the psychological impact of making good decisions and having what I would call more of a long-term investment philosophy. And so when you look at this, we're going to talk about the principles of sound investing and then give you some historical context. I always feel like the historical context, is necessary when we're around election time, because when we have leadership change, that's when I think we get anxieties or maybe stretched. They're at their highest level, or optimism. And so I like to go back and use history as a guide to really help us improve, help us think wisely, because I think during times like now, and especially around election years, is you have people cloud their judgment in terms of their decision making around the political dynamics. And so I want to make a firm case, which I've been doing again for the last several months, around why it's important to kind of ignore that. And I know it's hard at times, but really that's how we become successful investors. So when we start looking at the principles of sound investing, it comes down to consistency, courage, and balance. And that's what we're looking at. So when we talk about consistency, what does that mean? Well, when we look at this data here, this is just the last 20 years, looking at the broad markets. The broad markets, looking at the US stock market, is measured by the S&P. We're looking at government bonds. We're looking at inflation. So when you look at investment returns, pretty compelling to be an investor in stocks and bonds, where it's outpacing inflation over time. But this actually, historically, this 20-year period was actually not great for the markets. 6% return historically is well below the norm, well below the average. But if you look on the right-hand side, look at, this was a study done by Dalbar. The average investor return was less than both stocks and bonds. And it's like, well, how could that be? Well, a lot of it comes back to the investor behavior, making wrong decisions at the wrong time. And when we start looking at, so I want to apologize ahead of time. I know you guys probably laughed that it's like drinking through a fire hose when I go through some of these slides, but I do have a lot of good information today. And we make sure I have a pointer just in case I want to share this with you. So, all right, I got a pointer on here just in case. So the title of this is "The Herd is Often Wrong." And so what does that mean? How do we know when we're looking at what they know as the herd, right? The investment community. Well, when you see a lot of money going in one direction or leaving one type of investment, that generally means there's a lot of excitement or a lot of fear. And so what we're looking at here is, this was back in 2000s, if we remember that, that was everything.com did extremely well, off the charts. And the amount of flows, this red represents massive amounts of flows into the market. And then this, in the top chart up here is the stock market, the bottom are bond markets. And then if we fast forward kind of through what we'd call the fear trade and look at during the financial crisis, just subsequently following the financial crisis, which started here, you can see money was flowing into bonds and out of stocks. And so we know inherently that we want to do what, and you look at my amazing graphics down at the bottom, is that when there's a sale, generally, what does that mean? As investors, we want to come in and buy. We want to be investors when there's a sale. But in actuality, the opposite happens. When things go on sale, that drives more fear, it drives more concern, and it forces people kind of away from their investment discipline. So a lot on here, and just as a reminder, we will make the slide deck available if there's any data on here that's a little hard to read, because as we're getting into some of the nuts and bolts of the presentation, there are some slides that just have a lot of data on here. So one of the things is we all know, and I know you don't expect that of us as your advisory firm, is no one has a crystal ball, yet often people act as if they do, right? If we look at COVID and what we just lived through this last year, and we would have known the playbook, meaning how this past year was going to play out, many of us would have come to the conclusion that that would actually be a bad time to invest. And in hindsight, because of all that, the fiscal stimulus, the stimulus from the Fed, last year generated positive returns, much to people's surprise. And even though we actually can now look back and with hindsight make those decisions, we probably, even having that crystal ball, wouldn't have come to these same conclusions. And so that's one of the most dangerous things. One of the things we hear a lot, I shouldn't say a lot, from time to time, is clients will talk to us and say, well, I'd like to maybe hold some more cash, or hey, I'd like to do this, but I'm not trying to time the market. In actuality, that is what you're doing. If you are trying to hold cash or not be a long-term focused investor, now holding cash for needs, financial needs, is one thing. Holding cash because you're worried about the market is a whole different thing. So when we're focusing on being a long-term investor, nobody has a crystal ball. We all have the benefit of hindsight, but we have to be focusing on the long term. And so what this chart on the left basically shows is that if you're fully invested, what the returns are, if you miss the best 10 days, the best 20 days, the best 30 days, going back over the last 25 years, you can see your returns go from pretty decent returns to now either poor returns or negative returns based on those decisions. And then this chart on the right basically shows periods of volatility during different times. So we had the tech wreck, the financial crisis, and COVID. And you can look at some of these amazing days where the markets had, look during COVID here in March, in the middle of this, the market was up 9% one day, 9.3 one day, 6% one day. So lots of volatility during these periods of time. And so that's why it's important just to have this long-term mentality, and also to be an investor, using this opportunity to buy and to keep in position with your long-term goals. So the other thing that does happen at sometimes, not going to spend a ton of time on this slide, but there is this idea of something called the January effect. And then there's also something called sell in May and go away. Now, these are patterns that over the years have played out, and they worked. Well, the question is, was it circumstantial? Was it accidental? Or was there a reason it worked? And anytime you get a pattern in the market, it just tends to be random and not something repeatable. And so if you look at the data on here, the sell in May and go away is kind of the interesting one. So this whole idea is that you stay invested, you sell in May on May 1st, and then you stay in cash until November 1st, and then you invest. And if you just were invested for 6 months of the year and you were out of the market for 6 months of the year, the idea was you would do better. And if you actually look at the data down there, and this goes back to 1928, so it goes back, including the Great Depression, where just the buy and hold investor did better than that investor that sold in May and bought in November. So again, patterns might form, but it doesn't mean they're always going to work. So this is one of my favorites. A lot of people have the idea that investing is like the casino. The market's really like the casino, where you are just gambling on the decisions that you make. And the reality is that it looks like with some of my text up here, it didn't show up. So these were the odds of different casino games, things like blackjack, roulette, and different games. if you notice, they're all below 50%. So when you have the odds of winning at various casino games, they all by definition have to be below 50%, right? Because a casino couldn't open their door if they actually had a game or any sort of slot machine or anything that would pay out at above 50%. So they're always below 50%. But let's look at, if you're a long-term investor, if you have a 1-year time frame, you have a 73.5% likelihood of making money. If you have a 3 to 5 year time frame, you have an 85 to 89% likelihood of making money. When you're going out over 10 and 15 years, look at the positive returns. This goes back 120 years. So by having a 15-year time frame, you had a 99.9% period looking backwards that stocks were actually positive. So I would look at this as the antithesis of a casino, or the antithesis of gambling. But we are having some speculation right now, and you're seeing that people can turn investing into gambling. The AMC craze, maybe Bitcoin. I don't know what I want to throw into different things, but when we're seeing this level of speculation where people are just kind of bidding companies up, that to me does feel like more like a casino. So just remember, don't mistake investing for gambling, because you can definitely use the stock market for both. But those people that are long-term investors, the odds are dramatically in their favor, which is why that's where we want to focus. We want to focus in areas where the odds are in our favor. So over the long term, why does the stock market go up? Well, at the end of the day, the stock market tracks earnings, tracks profits. So if you look at this chart, the light blue chart shows the S&P 500, so it just shows the index, and it shows the volatility along the way going back to 1956. And then it shows where we are today. And then the darker blue line shows the earnings. So it's basically just showing, and they're on different they're on different axes, the data is, but it shows that the correlation between the index and the earnings are almost at 1. It's 0.97. So the reason why companies continue to go up, the stock market continues to rise, is because we have a very innovative economy. We have an economy that is producing great companies. And so that's what's driving things higher. And you can see there's volatility along the way. So it's not a straight line, but just know that's why stocks go up over time, because earnings improve. And that's the most important thing to remember. So the principle of courage, what does that mean? So every generation faces its share of challenges. When we look back, this is a fun exercise. If you haven't done it, looking at it with kids is pretty cool too, because the time that we live in, it sounds like, oh, it was never like this, or it was never this bad, and having then that mentality. But if we look back, this goes back to 1900, and it shows the dark blue line shows the volatility of the markets, but it shows actually what the markets have done over time. And these headlines are things like Black Tuesday going back to the Great Depression, dealing with the stock market crash in 1987, dealing with the assassination of JFK, right? We're looking at all these periods of time, which when you 9/11, when these things strike the market, markets sell off, right? These news events, these global political events, wars, economic slowdowns, all of these things drive the markets into greater periods of volatility. But the key is when you kind of get through that volatility, things get back to normal and things kind of progress. They progress back onto a normal path. And we don't know what the future is going to hold, but when you have faith that the system should be working over time, then you start looking and saying, hey, this is, we all have, every generation has its issues. That's not going away. And this is, again, something you don't need to ignore, but from an investment decision, it shouldn't drive your process. Lots going on here, really simple to discuss. And so this goes back to 1984, and it basically shows that since 1984, returns have been pretty solid. So 14.4% is the average annualized return for the markets going back over that period of time. And then the lighter blue underneath shows the medium intra-year volatility, meaning how much volatility do we actually get in the course of a year? So yeah, the markets might be up more often than not, and up on average, at least in this past history that we're looking at, 14%. Having volatility of 10% is normal. That's to be expected. And I think that's what oftentimes jars investors, from being able to stay long-term focused, because they see the headlines, which makes them nervous. Then you see the volatility, which then makes their account go down, but it goes down in what we would call more of a temporary loss, right? Because as long as you're diversified over time, we have confidence that things are gonna rebound and work their way higher. This also just shows that stocks basically have outperformed most asset classes. So you can see on the left-hand side, it shows growth of $100,000 since 1978. So we're looking at about a 40-year period. Look at these numbers here. So growth of 100,000 in small stocks grew to 11 million, and large stocks 10 million, and government bonds 1.7 million. And look at what inflation did, 380,000. So this shows the power again of being a long-term investor. Oh, there's lots going on here. So this basically says we hear all the time, markets are hitting all-time highs. They can't keep going higher. Well, that's historically not true. So since 1957, we've had 1,084 new highs. That's what markets do. They head higher. And that's generally what you'll see with the economy. The economy is getting wealthier. And so that statement of new highs can't continue is just simply untrue. We are going to continue to see new highs in stocks and real estate, things that grow over time. Bear markets are always scary, but don't have to be devastating. So again, lots of data on here. You can see the number of positive years and negative years. And so the reality is, as investors, we have to embrace that markets tend to be up about 75% of the time and down 25% of the time. So if we look at any calendar year, that's to be expected. And so 1 out of every 4 years is what we could expect for volatility. That's normal, that's healthy. So again, doesn't need to be scary, but even though you see the volatility, and it can be, just as long as you're making good decisions, it's not going to impact you. So if you look at real volatility and we start looking at, okay, well, what's happened in different periods of time? So if you notice here, a 5 to 10% correction since 1945, this has happened 41 times, and the markets take about 3 months to recover. Corrections of 10 to 20%, 14 times, and it takes about 7 months to recover. So these get to be the scary ones, right? When we get into a bear, when you're looking at down 20 to down 30, and that's happened 5 times going back to 1945 with about a 25 months or almost 2 years, or a little bit over 2 years recovery. And then the bear markets that are down 30 to 60%, that's happened 5 times with the average recovery of 49 months. So I think that's what is a little bit scary when you look at the volatility, but it's normal. This has been happening for decades. It's going to continue to happen. So the one thing that we are hearing more of, or more questions, is, okay, is inflation coming back? We think it might be. We don't know. We don't have a crystal ball. But we do think inflation is likely going to start to be a little bit higher. But when you start looking at, actually, I'm going to skip this slide. There's too much going on there, so I apologize. I'm going to skip that one. So the principle of balance. So we as investors have a home bias, or a bias towards investing in the U.S., which actually is fine by us. We don't try to deviate from that. I just wanted to make you aware of it. So if you look at the typical U.S. investor, they tend to have about 75 to 80% of their portfolio U.S. and about 20 to 25 international. And if you actually look down here, which is pretty remarkable, look at the stocks with a market cap over $1 billion, right? So these would all be small, medium, and large company stocks. And look at the number in the US relative to the number in emerging markets and international. So even though there's many more companies overseas, we still have a home bias. So not that I'm saying that that's a bad thing. We do spend money in US dollars. So having a home bias, I think, is okay. We also have some of the greatest companies in the world. But just be aware, by having this allocation in the 75-25 mix, you actually are overweighting to the US relative to what your portfolio size might need to be, looking at the entire world. This is a big challenge that especially retirees are dealing with, the challenge of low interest rates. So if you think about putting your money in a CD and our 1-year CD, how much income are you going to generate? And so this just goes back over the last 10 years. This is not even going back. If we went back even farther, it would be pretty dramatic. But you can see on $100,000 how low the amount of income that's being generated from a CD portfolio or from cash, right? You're looking at these levels where, at 2.5%, it's like 2,500, but look at where we are now, where $100,000 is generating $338. And that's on what's called nominal pre-tax, which means nominal is before inflation. So if you actually look at inflation, what's happening? Your CDs, your cash are actually losing money on a year-over-year basis. So then the flip side of that is people say, well, what if I just buy longer term bonds and say, well, you know what, I'm going to focus on longer term bonds. Well, here's the challenge. This is what people are concerned with: interest rate sensitivity. As interest rates go higher, or I should say when they go higher, if you have a 1% rise in rates, this is the typical volatility for bonds. If you have a 2% rise in rates, you can see. So the concern then is you say, well, I don't want to be in cash or CDs because the rates are too low. I instead would like to invest in a more diversified, longer term bond portfolio. You do have more interest rate risk, which will cause volatility to the downside in your portfolio, which I think is a challenge for retirees trying to balance. I want more income, but where do I get it from? So I know this has been full of historical context. We're going to go a bit deeper on some items here around myths and misperceptions, and then also some fun stuff, really looking at technology and innovation. So improving the human condition. One of the things that when we look at what our economy looks like right now, it looks so different than it did 100 years ago, 50 years ago, 150 years ago. So the data that I'm showing you basically shows what our economy, if you look at a percentage of the economy that different sectors drove in the US. So the first line, you can see these are all 1950. So 1950 was 40% US farming. In 1850, 40% US farming, 50% US manufacturing jobs, and only 10% service jobs. Look where we are today: 1% US farming, 11% manufacturing jobs, and 87% service jobs. This is what healthy economies do. They evolve. And I don't think there's many people out there that would argue that we should all be going back to farming as a mode of earning our living. And so this is how our healthy US economy has evolved over time. And this to me is progress. This is something to be optimistic about. Some other really kind of just really interesting stats are to look back at the growth of our world economy. So back in 1960, the world GDP, so gross domestic product, was $1.3 trillion. The US made up 40% of that. In 1990, that grew to $22 trillion. So 20 times in 30 years, remarkable. And the US actually, we shrunk. What does that tell you? That means the rest of the world is catching up. And then look in 2019, so essentially another 30 years later, the size of the world economy is $85 trillion, with the US making up 23% of this. So as the world has been getting wealthier, the US share of that has come down as a percentage, but you can see obviously the entire world has benefited from this growth of GDP. And this chart tells the story. So if you look back, the dates down here this is not like a linear description. So if you see here our linear chart, you see here 1820, 1850, 1870. So right here is 1981. So we cover about 150 years to 1981, and then we only cover 40 on the rest of this. So what this basically shows is that in 1820, we had around 5% of the world population not in extreme poverty, 5% in 1820. If we fast forward to 1981, that number basically jumped to about 50% of the world not in extreme poverty. And now in 2019, we have 90% of the world not in extreme poverty. So you start talking about innovations and wealth, and yeah, while it might not be distributed equally, this has been a major effect in improving the quality of life around the world. And this trend is only continuing. So hopefully we'll be able to close this gap. And I don't know if we'll get to 0 or 100%, but we're sure heading on the right path. Educated middle class. This is something that the rest of the world is really benefiting from in terms of the size of our literate population. Every year we continue to have more and more people read. And the amazing thing about that is the advent of the smartphone and the ability now people all across the globe are going to be able to access content and great content from anywhere from their phone is going to change these numbers. And that's where I think the one thing that people tend to be a little bit more pessimistic about our future, this is the one area where I think I have the most optimism, is because the smartphone is essentially changing the way that the rest of the world is going to participate. We as Americans have always been very benefited from the fact that we can, as citizens, participate in the world economy, where a lot of other nations did not have the wealth or the resources in place. And now we're looking at it where they do now, because of the access through the mobile phone. Let me see. All right, I do have a question here, but it's about tax policy, so I'm going to come back to that. How are we doing on time? We're doing good. All right. So this was a kind of a cool, I guess cool slide's not is the wrong word, but it had an impact on me when I was preparing for this. Is, you look at how much less violence we have in the world. And so on the far left is Genghis Khan, and looking at the percentage of the world population that was killed in world events. So during the Genghis Khan era, 11% of the world population was killed in that specific world event. If you look at World War II was 3.7%. If you look at the Vietnam War, 0.1%. If you look at where we are in the 21st century conflicts, 0.01%. So global violence has decreased dramatically. Hold on here. Let me make sure I'm okay. Oh, so this is always fun to look at here, and you look at. I think I've used this slide before. So some of you who come to these workshops quite a bit, it's probably been about 5 years. But this one's really fun. If you look over here, what the average American home looked like, what technology looked like in the 50s compared to today, right? So if you look at the average American home was 1,000 square feet with 3.5 residents. Now our average, the American home is 2,300, so bigger, twice as big with only 2.5 residents. So, and we've gone from 55% home ownership to 80% home ownership. Then you look at technology. In the 50s, 10% owned TVs. Now we're at 95%. The inflation adjusted cost of a TV, $2,100. Today, $500, right? So you look at all of this disruption. And then the bottom one, quality of life. 68 years was life expectancy, and 68 years with life expectancy with 50% of seniors in poverty. Now we're looking at 78 years life expectancy with only 9% of seniors in poverty. So we're making real progress. I think we get caught up in a lot of the noise, day to day. We are making true progress, and technology is a big driver of that. Now, we recently lived through the Great Recession, and because of, I truly believe, because of the wealth of our nation, we were able to weather that storm a lot better. Now, we did do it through borrowing money. We did do it through dropping interest rates. But that's one of the benefits of having a wealthy nation, is it allows us to navigate these really difficult times. And so you look at the Great Depression, how long that economic impact was: 43 months with a 50% drop in production, unemployment rates at 25%. Then you look at the Great Recession, 15% drop with 10% peak unemployment. So, and then crazy number up here, you don't even realize there's this many banks, right? The number of bank failures, 9,096, half of all banks. And in the Great Recession, 57 banks, 0.6%. So this is just designed to provide some perspective. And our monetary system, our technology innovation is putting us into an ability to continue to really live the American dream. And we do believe that the American dream is alive and well. There's a lot to pull apart in this slide. let's kind of talk about the left-hand side. So this talks about millionaires. So of the millionaires, and this data is from, it's 2011, so a little bit old, but nonetheless still relevant. 80% did not inherit 10% or more of their wealth, and 20% inherited some wealth from a trust fund or estate. So what it shows you is 80% are still self-made. Then we look at billionaires. So this was based on each member of the Forbes 400, okay? And it was looking at these different levels. And so if you look at home plate, right? So that's at the bottom of this, 21% inherited sufficient wealth to make the Forbes 400. These were those that inherited that. If you look on the on deck scenario, it shows that 38% individuals came from lower or middle class background, right? And then, you know, as you look around, you can kind of see where the other wealth came from. So this truly does show you that we have these opportunities here. It's what makes our country so amazing, right? We're looking at the fact that first generation wealth is created here. And there's not a lot of countries that can mirror and produce the same results that we have. So while a lot of times we can get down on things to improve, that's what's great about America. We can keep improving, and having that focus on getting better is what makes us great. But to say that the American dream is not alive and well, you wouldn't, the data is not suggesting that. It's still showing that millionaires are still generated on their own, and it's because of our amazing system. So another thing that's happening as well with our spending, you know, a dollar goes a lot farther. Now, we know inflation has eroded that, but look at where people would spend their money on these different categories, right? When we look at clothing, food, housing, other, and looking at the 1900s, people were spending 102% of their, you know, of their expenses were 102% of their income. Then when we fast forward to 2019, we're looking at, you know, now 78% of income, but look at how the other bucket is filled up. You know, those are more leisurely activities, more enjoyable things. And we have a lot less money spent on clothing, on food. We are seeing more spent on housing, which we obviously know the impact of that, especially here in California. So you've all seen this one. Hating the government is not an investment strategy. I'm just going to keep reusing it because I think it's really important to not let this drive your primary decisions to be an investor. So waiting for your team to win before you invest. So if you took the approach that says, okay, I'm only going to invest when my team is in the presidency. So this goes back to 1896. So there's lots of data. So you can see the wealth accumulation or the wealth destruction of taking that mentality. So if you are just invested 10,000, that 10,000 has grown to 7 million since 1896. And look down at the bottom, you can barely even see it down here, is where if you only invested when Democrats were in office, this is what your wealth would have grown to, and only invested when Republicans were in office. And so, and again, this is when you had a unified government, right? Versus divided. So having this mentality of, I'm gonna wait for my team to be in place before I can have confidence about investing, it just hasn't proven right. So we think that's a mistake. We think you should have this long-term outlook, this long-term approach. The other thing we're getting a lot of right now is the U.S. is a bad credit risk. We're borrowing so much money. This shows 25 trillion. We've breached, I believe, 30 trillion, especially with all the COVID relief packages. And now, while it's daunting, it's scary, we do have to deal with it at some point in terms of a continued growing debt. When you look at the debt relative to the assets we have, we're actually not that out of balance. Now, I'm not making the case for we should be reckless with spending because we don't want to do that. But if you look at the assets, so we have 25 trillion of liabilities, we have over 200 trillion in assets from land and building and commodities. And you can see all those listed there, financial assets, things like that. So we are in a position where we still have a lot of assets, but I don't want to say we're a bad credit risk, because obviously if we were, people wouldn't lend us money, and we still get money lent to us as a nation. We do need some more fiscal discipline, but it's really important to know, because when you start lopping off zeros, many of us are okay taking on debt to buy a house, to do different things, right? So if you were worth $10 million and you had $1 million of debt, would you call yourself irresponsible? Probably not, right? You'd probably be okay with that. And that's similar to this ratio. Technology drives growth and is nothing to fear. So I love looking back at the old technology of the day, right? Because to us, it looks silly because we see the technology that we're utilizing today. So the technology in the past just seems, it seems so, like, I don't want to say obvious, but it doesn't seem so spectacular because of what our technological improvements have been. So if you look at just some of these items on here, right? Compressed time. So how do we compress time? Well, you go from a wagon train to a steam locomotive to a Ford Model T to an airliner, right? And then to a jetliner, right? You talk about compressing time and being able to travel and get around the country. Expand knowledge. Stone tablets, I don't know if I would call that technology, but all the way up till now is, when I grew up, it was a library or it was Encyclopedia Britannica. Now it's Wikipedia and obviously numerous sources. Personalized experience. Going from a radio to a TV to cable to DVD to Netflix to streaming, right? So streaming is obviously the biggest way, and people are cutting their cable. The way they consume data is changing rapidly. And then reducing costs, being able to run your factory. And you can see we're up in the 3D printing world where things are going to be produced at a lot cheaper levels. And this then shows this whole idea that I think are a little bit trained, and I think incorrectly, that technology and innovation kills jobs. And it just simply doesn't happen. Technology and innovation expand jobs because we create new categories, we create new sectors. And so this just basically kind of shows the history of where GDP per person was, how it's grown over the years, going back over 100 years. Our GDP per head per capita has gone from 4,000 to 48,000. And you can see the advent of all the different technologies. And then you look at unemployment rate. So look at what an unemployment rate has been historically low. And that's been in this last 20 to 30 years. We've had it extremely low, below average, except for a couple spikes in there. And that's when technology innovation has been happening at a much faster pace. And if you see the note up at the top, it's a little hard to read. It says, despite 10 times population growth. So, we've been able to have unemployment come down despite the fact that our population has grown by 10x over this period of time. 5 Ds of technology. So if you look at kind of where we're going, we know that democratization, which is bringing the world together, look at the dematerialization, getting everything on the phone. You don't need extra stuff. You have one phone and you're good. Looking at deflation, right? Technology is highly deflationary. It's cutting out the middleman. Big data, and then disruption, right? So these are the things that technology is driving. So when you start looking at the advent or mass adoption rate, so what we're looking at here is years to get to 80% adoption rate for US households. So the telephone took 91 years, electricity took 69 years, air conditioning took 86 years, the automobile 67, television 46, the computer 29, the cell phone 25, the internet 21, and the smartphones 10 years. So you start thinking about the adoption rate again, because technology innovation is continuing to move forward. And so that's just remarkable when you think about that. And this always, it's amazing. You look at this picture, things that you would need to purchase that a lot of people don't need anymore. Alarm clocks, cameras, flashlight, GPS. There's a picture, it looks like of an ATM on here. Your wallet, your credit cards, radio, calculator. So think of what it's replaced. Thomas guides, yellow pages, all this equipment is now on one device, which is just truly remarkable. And when you start looking at the fact that on an inflation adjusted basis, look at the cost savings that you're getting on this. The computer from 5,000 down to 700, the cell phone from 9,000 to 500, televisions, you remember those big televisions, that's 1985. Looking at these massive televisions that, would weigh 2,000-3,000 pounds. It might be a tad of an exaggeration, but extremely heavy. And now down where you have TVs that, I almost feel like a lot of the TVs are, I don't want to say throwaway, but it's like, oh, I need to get a new TV. It's $400, no big deal, right? So you're continuing to see technology drive prices down, drive prices lower. And then obviously this is what's in sight for us here in the future. Big data is going to change everything. We're seeing that with people who have iPhone or iWatches. We're seeing the changes that are happening with telemedicine. COVID really is expanding the need for this with all the Zoom technology and the fact that we're here today, not in person, where we're doing this remotely. You know, this is really what we're having for the outset, or excuse me, this is really what is in the near future for us. We're living it now. But look at some of these areas up here, driverless cars, right? We're there right now. Not all driverless cars, but that's already occurring. And so this is going to continue to drive our economy forward. And again, being overly pessimistic about our future, I think, is going to be one of the biggest mistakes investors can make without. And I think having that optimism that things are going to continue to move forward is going to be the way to be a successful investor. And this just kind of runs through a bunch of different companies. If you start thinking about like what did people replace, like there's one over here, it's like Blockbuster and Netflix, right? So, and then you have Amazon and Borders, and you have Uber and taxis, and you have Google and the library, right? So you look at these new companies, a lot of these companies on here didn't even exist 20 years ago. And because we constantly are disrupting. And when you really are when you look at disruption, they're going to evolve or reinvent themselves to survive. And that's where these new businesses form. All right, I know it's like drinking through a fire hose, but I wanted to keep us moving and on time. So overpopulation, demographics, and energy. So this is gonna be a quick one. Overpopulation and food shortages. That is something that people have kind of said throughout the years that was going to become an issue. But look at the chart here on the left-hand side. The entire world population could fit in the state of Texas, the entire world population. And it would only have the population density of New York City. So that really shows us that, you know, we have a lot of room on this planet. Now, I know our resources are precious. I'm not making a case where we need more and we need to be wasteful. But that's always been a fear. And we're at a point now where, you know, when you look back over the last 60 years, we actually have more world grain production. Yeah, it's grown much faster than world population. So people's fear about the future have not come to fruition. That's really what I'm trying to illustrate here. You also look at, there was a scientist, I believe in the 60s, who predicted peak oil, meaning oil was going to peak and we were going to go down, and it's going to be a scarce resource that we could no longer use. Now, we might make the case that we shouldn't be using oil anymore. That's not really the point of this. But if you look at proven world reserves back in 1985, where we are today, and you know, we are now a net exporter of energy, pretty remarkable. It definitely changes the political landscape for us. So peak oil was wrong, right? Plenty of people who were pessimistic 40 years ago, 50 years ago during the oil shocks, but they were simply wrong. And you know, we get to actually look back and kind of judge the decision makers around that pessimism that did not believe that we could move forward. All right. So I can take a breath. All right, we covered a lot there. As we are wrapping up, I'm just going to kind of, I'm going to need to find a slide to hang out here on. Obviously, that's our team. We actually have added 2 more people here in the last couple weeks. So you'll be getting an email from us about some of our, I should say new additions, but we basically brought back two people. So, and then our next webinar. So as a reminder, if you're on Facebook, if you're on LinkedIn, like us. This is where a lot of our content will come to you. And our next Advanced Perspective webinar is on March 16th. So it's one month from today. And let me see if I have some questions. So if anybody doesn't want to stick around for any Q&A, you can sign off. Thank you very much. And I hope this was valuable. And I do have a question here. So this is a tax question. I got 2 questions here. So, ooh, I got more coming in. All right. So you mentioned at the last webinar the possibility of capital gains rates under Biden doubling from 20% to 40%. What is your perspective regarding the viability of taking significant cash distributions from funds now in effort to beat this tax increase? Okay, so great question. That's a hard one to answer. So when I talked about the potential of doubling the current capital gains rate, that was only for the group above $1 million. Now, again, I'm not saying that's a good thing, but it was really for earners above $1 million. So for the vast majority of Americans, that does not apply. And remember, this is for capital gains rate. So if you're talking about taking cash distributions, I'm assuming you're thinking maybe from an IRA. Those are already taxed at ordinary income. So Biden hasn't been proposing higher taxes on all ordinary income, just ordinary income above 400,000. So, excuse me, it would really just depend on where you fit in that income bracket. Something we can discuss individually because it's a good question. My comment wasn't designed to kind of scare and say you got to be worried about this, but that was just one of the tax rates that I was like, that could be fairly punitive, right? Doubling a tax liability. But I don't think the solution is taking more cash out, realizing more gains is the best solution, because we're still really early in the year. It's a possibility that any tax plan that gets adopted is going to be for this entire year, meaning retroactive. So when you file your 2021 tax returns, even if you did things in January or February, and let's say the new tax policy is not in place till March or April, that it'll likely count for the entire year. When Congress historically has passed tax reform and it's gone into effect like in December, they generally don't go retroactive, but when it happens early in the year, kind of some of the CPAs that I've talked to think that will likely be in place for the whole year whenever those changes are made. So thank you for that question. All right, I got two kind of questions around GameStop, so it doesn't surprise me. What do you think of the recent GameStop activity, and will the GameStop event change the stock market in the future? What do you think? So there's a lot there those are good questions. So the GameStop activity, basically, without spending too much time on this, obviously created massive amounts of volatility. This is what I refer to more of what I would feel like gambling, right? Where you have speculation, where you have a stock that goes up. I mean, I think it went up like 1,000%. I mean, it was a pretty amazing movement. So what do I think about it? I mean, I don't think generally that kind of volatility is good for any markets that are trying to focus on being, long-term and being investment focused, not gambling focused. The GameStop did uncover a lot of big investors that got caught and lost billions of dollars in some cases. But I also don't know if they're going to prove, and this might turn out to be illegal because it was basically a website that drove people to act in one way. And generally with the markets, you're not allowed to do that, right? You can't have people that are colluding to drive things up or down. So I don't know how that's going to play out, but more importantly, how it's going to impact you and how it's going to impact me. I do think, unfortunately, there might be some more regulation. And when I say regulation, they've been talking about putting some sort of a transaction tax on buying and selling. So I think that's one of my fears, is that all of what's been happening might cause Congress to take the approach of, we need to tax this, all the trading, because most of these apps now are like free trading. So it's just causing probably a little bit more speculation than normal. But that's my big fear, is that in the future that we're going to have more regulation in place, which I don't think is great for free markets, because any long-term investor didn't get hurt by that. Those are the people who were overly speculating, who either got hurt or made a lot of money. And so it didn't really have any impact on our portfolios, and doesn't really concern me. I just don't like that activity, because you can't tell if is there cheating going on, really what's happening. So no, it's a little bit of a long-winded answer, but that, again, my big fear is that it's going to add some more regulation in, which generally is not great, in my opinion. So that's it for questions. So thank you. Hope you enjoyed. So I haven't figured out what our next topic's going to be next month, but I'll try to bring something exciting. And if you have topics you'd like me to cover, I've been doing these webinars. We're coming up on the anniversary of when we got shut down for COVID. So if you have topics that I have not covered that you want to cover, let me know.